Hi guys, and welcome to another week ahead video. Now, this upcoming week is going to be a very light one in terms of economic data points. The main highlight is going to be Wednesday's FOMC meeting minutes. And then on Friday, we also have a few market Flash PMI numbers. So for that reason, our main attention this week will focus on the euro-dollar currency pair. We've seen some interesting moves over the last couple of weeks, and there is a few interesting idiosyncratic drivers that can affect the pair in this upcoming week. So join me now to the video to see exactly what we're looking for the euro dollar this week and how we're hoping to trade it in the upcoming week as well.
Okay guys, now we have a very light economic calendar in the week ahead, with the main highlights being the FOMC meeting minutes on Wednesday, and we also have Flash PMI data out on Friday. So with the light calendar and these events in mind, our attention turns to the euro-dollar pair this week. Now, the pair has been on quite a tear from May, actually March this year. From the middle of March, the euro-dollar has gained over 12%. After currently just topping out at that 119 level. Now, the run to the upside has been exacerbated as there was both upside factors pushing the euro higher, and at the same time we had factors pressuring the US dollar to the downside. Now, the euro upside was mainly driven by the EU recovery fund, as well as the massive 1.3 trillion euro stimulus pandemic emergency purchase program. And this combination of unprecedented fiscal as well as monetary policy support was one of the main drivers for the euro's strength. Now, on the other side of the coin is the US dollar. That has been pressured by multiple factors, namely the inability to control the virus compared to places like Europe, huge amounts of liquidity from Fed stimulus trying to put the dollar lower, expectations from the Fed to basically eventually implement more easing policies such as yield curve control, average inflation targeting, etc. And then we also have Europe's outperformance and recently US stimulus bill concerns. Now, has any of that really changed significantly? In the broader view, not really. So why then has investment banks like Morgan Stanley recently turned tactically neutral, and why has banks like Nordea and Credit Agricole actually taken short positions on the pair? Now, we'll dive into this in the week ahead section of our report, as we have plenty of drivers this week that will show us where the pair is most likely headed in the week ahead. Looking towards some of these factors, the first one we need to consider is positioning. Now, it should be no surprise that the medium-term bias for the dollar is still tilted to the downside, given all the reasons mentioned in that first section of the report. However, the size and the speed of the drop has been a little bit on the extreme side, to say the least. Now, plenty of investment banks expected the euro dollar to reach between 118 and 120 by the end of 2020. And the recent rally has basically caused many of them to revise those targets even higher. So the fact that the medium-term bias remains to the upside is fairly well reported and expected, but the positioning of both the euro and the dollar muddies the short-term picture at the moment. Morgan Stanley shared a recent note where they explained that the US dollar is currently the most oversold it's been in the past 40 years and short-term positioning is stretched. Now, at the same time, we actually have the euro that has reached a historically high net long position according to non-commercial CFTC data. So from a purely positioning point of view, we have the US dollar at the most oversold in 40 years and the euro reaching historically high net long extreme non-commercial positioning. Now, does that mean that the pair stops going up from here? Now, there are some that would argue no, by just looking at the weekly chart of the dollar index. Some tech analysts did note in the week that we've broken a major key trend line for the dollar index going back all the way to 2011. However, there is one caveat to this that we need to keep in mind, and according to many market participants, the only meaningful measure of the US dollar is actually the trade weighted US dollar index as opposed to the dollar index. Now, the TWI is more accurate and much more relevant to use according to these analysts, and the reason for this is that the index uses a much bigger basket of currencies compared to the dollar index and has also a more accurate trade weighting. Now, those only watching the TDI says there might be some more room left to the downside. Participants should be preparing themselves for the mother of all bounces in the dollar once we reach that major descending trend line, possibly in the region of that 90 level. So comparing the dollar index that has broken through and the TWI. What does all of this tell us? Well, the point I'm trying to make by showing you both these charts and both these two opinions is that there's definitely not a consensus view right now in the short term with regards to the dollar, and that obviously affects the way that we need to look at the euro. So that is definitely something to keep in mind for the weeks ahead, especially this week ahead, comparing that positioning in the dollar versus the euro. Also then looking towards virus development, one of the reasons for the euro's outperformance versus the dollar has been attributed to the virus, as the US has been unable to control the virus as well as Europe has. Now, however, the recent trend of new cases in both regions are something that we've been highlighting as a short-term potential driver that might give euro bulls a reason to take some additional profit. Now, this chart from Financial Times is really helpful because it shows us there's a clear trend in the US cases moving lower, while we have that divergence of EU cases actually moving higher. Now, while new cases has shown a noticeable slowdown, it is worth noting that one slowdown or one hiccup to the downside or to the upside doesn't mean that that trend continues, obviously. So that is just something to keep in mind. It is a potential risk factor. But if that trend does continue and it gets out of hand, and Europe is faced to put in strict lockdown measures, that will create some short-term potential downside for the euro. The third one is geopolitics. Now, something that has gone somewhat unnoticed by markets this week has been the escalation in the Mediterranean between Greece and Turkey. Now, the issue started when Turkey recently deployed research vessels into disputed waters off the coast of Cyprus to explore offshore gas and oil. Now, Greece has responded with disgust and outrage, saying that the waters covers part of their continental shelf and has demanded Turkey to withdraw these vessels. And to make matters even worse, Turkey also sent warships to actually escort these vessels, basically flexing their muscles versus Greece. Now, in order to calm down the situation, we had French President Macron ordering French military forces into the area, and has also raised the possibility of sanctions on Turkey if they continue with this endeavor. So even though the situation now remains calm, it could raise some alarm bells for the euro if things unexpectedly get out of hand. So definitely want to watch. In terms of economic data, we've got two main events to watch. The first one would be the FOMC, as we said on Wednesday. At the last meeting, the Fed chair explained that they were concerned about the recent downtrend that they've noticed in some of the high-frequency data, and again reiterated their commitment to basically just do whatever it takes for as long as it takes to support the economy as well as the recovery. Now, for the US dollar, the focus will be on any comments on things such as forward guidance, average inflation targeting, yield curve control, etc. And if the bank alludes to any of these policies in the minutes, that would create some further downside pressure for the US dollar in the week ahead if they trying to preempt the markets that these things might be on the horizon as soon as September. Then on Friday, we have the latest market PMI metrics for August. The PMI data out of the Eurozone has been very encouraging for markets recently, and has shown that purchasing managers at least have been more optimistic about the overall recovery. Now, one point to mention here, of course, is that PMIs are diffusion indexes. Now, that means that they are good to measure the extent to which businesses feel better or worse about the current month compared to the prior, but it doesn't give us a measure of the actual economic growth. So just always keep that in mind. So then looking at some potential dovish and hawkish sentiment shifts for the euro dollar, the trickiest one to plan for this week ahead will be the positioning point of view. Just because something is at a historic net long position like the euro or oversold like the US dollar, it doesn't mean that the market will necessarily reverse or correct. So just keep that in mind for the week ahead. Looking towards the other drivers, of course, we need to focus on that divergence in the virus cases. Now, we doubt whether we'll see the type of intense lockdowns we saw previously in Europe. We'll probably only see governments trying to do regional and more granular type of lockdowns, but any announcement of major lockdowns, large-scale ones in economic sensitive areas, could lead to short-term euro weakness. The geopolitics, another one to keep in mind, that Turkey-Greece situation. Any possible skirmishes between EU and Turkey military forces in the Mediterranean can also create short-term downside for the euro, especially if it causes some rush to safety, which might actually be a positive for the US dollar, even though markets in this current environment would probably favor the yen as opposed to the US dollar, so keep that in mind. Finally, the biggest dovish shift will most likely come from the FOMC meeting minutes on Wednesday and then the Flash PMI data. If the market interprets the FOMC meeting as not as dovish as expected or not dovish enough, it could create some short-term strength in the US dollar, even if it's just an unwinding of some of that overly short positioning. and that will of course weigh on the euro dollar. In terms of flash PMI numbers, markets expect the strong upside trend to continue for now in terms of EU PMI data. So any unexpected drops below the market's minimum expectation could be enough to give the euro a little bit of a deeper push down as well. Turning to hawkish sentiment shifts. Now, as long as the virus situation doesn't lead to a large scale lockdown, of important economic hubs in the Eurozone, the damage to the euro should be overall contained. The biggest positive driver for the euro dollar in the week ahead will most likely come from that FOMC meeting, as we said, as well as the flash PMI data. For the FOMC, markets will be looking for any possible mention of yield curve control or average inflation targeting in the meeting minutes. And if the comments allude to the possibility of these two policies being implemented this year, that will add another weight to the US dollar's downside and could see the euro dollar break higher. Then turning to the post-virus rebound, of course, in that euro flash PMI data, it's been very impressive recently. That has really added to that outperformance of the eurozone narrative that we've seen, adding weakness to the dollar. Now, any further positive surprises in the French, German, or the EU flash PMI numbers as a whole, printing above, of course, the market's maximum expectations this week, might provide another lift for the euro as well, especially so if the later US flash PMI data, also released on Friday, shows a slower pace of recovery compared to that of the EU data. Now, looking at a potential plan for the week, a trading plan, taking a look at the chart, we can see that the euro dollar has basically been stuck within a tight range between that 119 level of resistance and then support at 1710. Now, above 119, the next area of higher time frame resistance actually comes in at 120.40. Thus, any catalyst that sees us finally breaking back above that 119 level could provide a further push to the upside and retest that area higher, maybe even retest as high as 121. Now, we also have the pair currently flirting with a major weekly descending trend line, and as long as we stay above that, it could provide a little bit of a floor for the pair to form a little bit of a new base area, so keep that in mind as well. To the downside, of course, we have some key support levels sitting at the 1570 as well as the 114.95. So if we can break below that key support, the recent floor at 117.10, that would probably open up the door to a further push to the downside. Looking to retest these higher time frame support areas. We also have the 50% fib level as well as the 61.8, not too far away from these levels, so we do have some confluence to expect the pair to reach these levels. Do keep in mind, however, that the bias, especially from the medium term perspective, is still tilted to the upside for the euro dollar, and we would expect buyers to step in at any of these key levels. So do keep that in mind, not to overstay your welcome to the downside in this one. Another interesting one to note for the week ahead is that we have over 3 billion in call options rolling off for the euro dollar at 119, and that is basically split over Monday, Wednesday, Thursday, with each day adding about having about 1 billion expiring at that 119. So that means that the 119 could act as a bit of a magnet in the week ahead. So definitely something to also keep in mind, especially for that upside bias and a possible break back above that 119.